In this video, we're going to talk about the covered call, which is very closely related to a buy-right strategy and may be used in options trading to amplify your profit potential while mitigating risk. A covered call is when you receive a premium in exchange for giving someone else the right, but not the obligation, to buy the stock you own at a specific strike price within a designated time frame. It is a common strategy many investors use to earn additional income from their stock positions while not taking a large amount of risk. Let's break it down with an example scenario. Imagine you own 100 shares of a company called FlyFit, which you bought for $50 each. Believing that the stock price will remain relatively flat for the time being, you sell a call option with a $55 strike price that expires in a month. In return, you get a $3 premium, or $300 with the option contract multiplier. From here, two primary outcomes may unfold. If FlyFit's stock price remains under $55, the option expires worthless. Not only do you retain your shares, but you've also pocketed the $300 premium, extra income you would not have otherwise earned. On the other hand, if FlyFit's stock price rises above the strike price of $55, then the buyer of your call option might exercise their right to buy your shares at $55 each. Since you originally paid $50 per share, you stand to make a $5 profit per share, or $500 total. You also get to keep the $300 premium you earned for selling the call in the first place, meaning you've made an $800 net profit. But here's the trade-off. Your profit is capped at the call option strike price. If FlyFit shoots up in value to $70 per share, you won't benefit from that extra increase. Your maximum profit stops at $55 per share. Covered call strategies allow the investor to earn extra income in exchange for giving up the profit potential if the stock rises more than the strike price. If you understand the risks, a covered call strategy may provide potential income opportunities. That's because you're not just waiting for stock prices to move. You're proactively generating income, even when stock prices stagnate. That premium from the call sale, it's yours no matter what. Plus, a covered call serves a dual purpose for those eyeing a potential exit from a stock position. It may offer extra income while you wait for the stock to hit your desired sale price. Of course, like all option strategies, covered calls have potential drawbacks. For one thing, as we mentioned earlier, your profit potential gets capped at the call option strike price. That means if the stock suddenly skyrockets in value, you could be left feeling a lot of remorse when the buyer of your call option may profit from all those additional gains. You must also ensure that you actually own the underlying stocks that comprise your call option contract and do not sell them prior to the option expiring. If you sell a call option without owning the related stock, you're stepping into naked call territory. Naked calls may expose you to significant, even unlimited risk, as you might have to buy the stock at whatever market price it's trading at to deliver it to the option buyer. It's worth noting that Public does not currently offer the trading of naked calls, as they can prove to be extremely risky and may not be appropriate for many investors. So that's an overview of covered calls, an option strategy that involves selling call options on a stock you already own. Covered calls offer limited return for limited risk and are a popular way to generate income through options premiums.